Okay, I'm now recording the meeting. Go ahead and get started. Go through the administrative stuff first, just so you know, everything we're doing is for educational purposes only. I'm not giving you any specific trade advice. What we're showing you is purely how myself and Becky, who's my trading partner, how we approach trading the markets and profiting from the markets. But no specific trade advice on any particular item. Okay, so that is the administrative stuff. And we're going to get right into it. First, I got to ask the question, is there anyone who doesn't understand a basic candlestick on a chart, the open, high, low, and close? Let me know, and I can go over that real quick. Open, high, low, and close. Does anyone not understand basic candlesticks?
I understand most of it, but yeah, if you could review it, that would be appreciated.
Okay. I'm going to switch over to the charts. Most of what we do is on a chart. We can actually use this. I'll switch to the chart. Let's see, share. You should be seeing a chart right now of the QQQ, the NASDAQ. So you see green candles and red candles. The green candles can be different colors depending on what you choose to set them to on your particular chart. But on this particular chart, the green candles represent an up day and the red candles represent a down day. Green meaning up day, meaning it open. See the body right here, the box, the rectangle. The low part of the body is the open price for the day, and the upper side of the rectangle is the closing price for the day. So with an up day, the day finished higher than it opened. The low point, the wick, is the low of the day, and that's the high of the day. Take another one. This candle right here. Here's the open price. In particular, look at the data box on the left side. Here, it'll match up. The low part of the rectangle is the open price. Upper part of the rectangle is the closing price. Here's the low price of the day down here and the high price of the day. That's it. On a down day, it opened here, closed lower. That's all we have to know. For this strategy, we're not doing all of those fancy candlestick patterns. We do have those, we do trade those, but not for this particular strategy. We do have those more for futures. All right.
By the way, doing futures, what can you expect to make?
We're not doing the futures today, but the futures are probably 2 to 3 times as profitable as the options because we don't have time decay, same percentage wins. You make probably 2 to 3 times as much with 1/3 as many trades. If you haven't seen it yet, email me after the meeting and I'll send you a recording of the last futures meetup. And it will give you a really, really good understanding of how we trade futures and the expected profitability. Because since futures are more specific, I went through a very detailed, for the last several years, taking every trade, what the expected actual profitability is in dollars and cents to expect. Pretty approximate, pretty close to reality there, what to expect, risking a certain $1,000 a trade. And it came out to a 40 to 50-something% annual return. I said that is with 1/3 as many trades as the options, because it's a whole different way to trade. But email me after the meeting, or email me now if you want, and I will send that to you, that link to you with the recording of the futures meetup, and I'll give you a really good feeling for the futures because I really, really love futures. It's been our bread and butter for a long time.
Yeah, that sounds like a better thing. Now you're saying you make it like $1,000 a trade. But
no, you don't make 1,000. You risk $1,000. If you risk $1,000 a trade, there's an expected return on that.
Yeah,
and that is what with the futures, it's a 40 to 50% return minimum on a trade.
Per trade, you mean? So the percentage that you risk, you're talking 40 or 50% return?
No, you are risk for every, let's say you risk $1,000 on every trade.
Yep.
On a futures trade, on every single winning trade, you will make at least a 40 to 50% return on the $1,000.
But that's on the winning trade. So what percentage are winning trades?
80 to 90-something% winning trades. Do the math. Comes out
Yeah,
really
but
nice.
even with that, you only come out making 40 or 50% a year. I mean, I think you'd be making more than that, huh?
Only if you want to make more than that, you have to take a higher risk. That's risking 2% of the account.
Yeah,
If you want to risk 3% of the account, then that 40 to 50% return goes up to 60-something% returns. See what I mean?
yeah, yeah.
Yeah, so it's up to you, but we always say 2% of the account risk per trade. If you want to do more, I wouldn't even recommend more than a 3% account risk.
Okay.
Don't get too greedy with it because it can come and bite you, in the butt at some point in time. So
Yeah, eventually you'll get,
yeah, you can the more conservative you are, whether it's options or futures, the more conservative you are, the more money you will end up making. Yeah, so also I'll send you email me later, and I might put the link into the thing here too, so you can get it into the chat room. Becky posted the link for the handouts. So you can, that is in the chat window. See if you want to go ahead and download it from the chat window. Becky, can you just post the link for that whole website so people can go to that page for everything else? Everything's going to be on, all the handouts and everything will be on that site. So just post a link for that, just a website, not just a one file, and that'd be great. All right, so let's go to the trading plan for a moment, and we'll get back to the chart.
Now you say, so should I be clicking on the handout? It says handouts for today. That's where I should be.
The handout is for today, yes.
All right.
It's a PDF file. Okay. Today we're going to go over one of Becky's favorite strategies we do, and that's a Donchian crossover. Some of you have seen it before, but it's a relatively straightforward, simple strategy, but boy, it works so well. We used to trade mostly Ichimoku strategies, and then several years back, we changed over to trading mostly Donchian strategies, because using the Doncian indicator combined with our approach to trading, we were actually able to get more trades, be able to use less expensive options going out that didn't have to go out as far in time, and still maintain that 84 to 90-something% winning trades. This is one of the first. This is a strategy that works in bullish markets and bearish markets. When you see a big decrease in the market, this will be one of our first buy signals. When you see the market trending up, this will be a trade that also comes into play. But yes, it will be one of our first buy signals following a decline in the markets. So this is going to be a Donchian crossover, and just take a look at this real quick, but not important right now. I'm going to go back to the charts and show you what it looks like on the chart, because that's where we do stuff, is the chart, not so much the writing. All right. So this is the chart of the NASDAQ, the QQQ. The blue line is a 40
I'm sorry
period
to
simple
ask
moving
you,
average. Yeah.
but I don't know. I clicked on that link of yours, and I got sort of mixed up, and I lost your. So I lost your
Let me
program, and I
put
just
the
got back
page,
on it.
hang on a second. I'm going to put the page up. Let's see. So just posted in the chat window the website, and all the handouts and spreadsheets are on that page. If you go to that website, you will be able to access all of the handouts and spreadsheets that you'll be seeing this afternoon. So that's the website right there.
Yeah, I got that, but I lost your window for a while. So whatever you were just explaining between the time you said click on that handout and the time I just spoke to you, I don't know if there's anything significant that
Oh, no. I just went back to the charts. Okay, so we're on the charts now. So the blue line is a 40 period simple moving average. This orange colored line is a Donchian mean line. The Donchian indicator is 3 lines. We're only using the mean. I made the other ones transparent because we don't want a bunch of extra lines on the chart, taking up space, creating confusion, which we don't actually use. The dotted line is the upper Bollinger Band. We only use the upper Bollinger Band, so the middle line and lower levels are not shown. So we have 3 lines on the chart. The blue line, 40-period simple moving average, orange line, the Donchian mean, and a dotted line, Bollinger. The colors on the chart all match the colors in the data box. So when we see the mean here, that matches the Donchian mean. When you see the blue here for the SMA, it matches the value here on the chart. And upper Bollinger Band, it matches the Bollinger Band value. You can't always just know what the value is by eyeballing it. So you have to look at the exact numbers sometimes to see exactly what the values are. Okay, so this is a real simple strategy to identify on a chart. When we do our daily review, what we're looking for is a setup, visually a setup. And for this strategy, our setup is for this orange line to cross over the blue line. So that is visually what we are looking for. Orange line to cross over the blue line. So when we do our review this day, did the orange line cross over the blue line? No. Next day, did the orange line cross? No. No, nothing, no setup, nothing, no. Hey, orange line cross over the blue line. Now we have something to spend a few more minutes looking at. But that's how we do our daily review. Click, did it cross? Nope. Click, did it cross? Nope. Click, did it cross? Nope. Move on. It goes that fast. So you can review 20-something ETFs and sectors in about a minute or two. If there's no line crossing, there's nothing to spend time on. That fast. Okay. Now we would go back to our trading plan, which tells us that it must close underneath the Bollinger Band that day. This is our signal day. On our trade signal day, it did close below the Bollinger Band. So it's valid. And this orange line had to be below the blue line a certain number of days. That'll be in the detailed trading plan. And we're good. Once we know that, we have statistics for every ETF. When I say statistics, I'm going to go to back to the handout and show you what I mean. So I'm back on the handout now. For every ETF we trade, is 28 ETFs with different sectors. We know percentage-wise what to expect historically, and it doesn't really change all that much. We know that this is an example for XLB, material sector, that if I have a 1 ATR target, I'll talk about ATR in a moment, that it's 92% wins if I give 1 expiration cycle worth of time for the option. And I know we have 96% wins if it's 2 expiration cycles. The only expiration we deal with is the 3rd Friday of the month. All those other option deals expiring all different times, weekly and stuff like that, those things only got created in the last 15 or so years. We don't deal with that. We only deal with the option expiration that's been around forever, which is the 3rd Friday of the month, and that's it. We don't deal with any other expiring options. 3rd Friday of the month, that's it. So when we say 1 expiration cycle, from the Monday after expiration Friday until the following month expiration Friday, that is 1 cycle. So if it shows here that I require 1 expiration cycle worth of time, then that is the minimum amount of time I need in this option. If it says here I need 2 expiration cycles, that would be literally from the Monday after expiration Friday until the following month's Friday, and then the next Monday after the next month's expiration Friday until, so 2 full months basically of time. Okay, so we maintain these stats for 28 ETFs. That's how we know what to trade. That's how we know the percentage meets our criteria, which is over 84%. And that's how we make decisions on which ETFs to trade and which ones to pass on if we get a valid setup and trigger. I just said a whole lot of stuff. Do we have any questions, especially on an expiration cycle?
Yeah, I'm a little confused here. You talk about sometimes you do one expiration cycle, but then sometimes you do two expiration cycles.
Correct.
I don't, so you're saying you let the trade sit for two expiration
No,
cycles?
you let it, are you familiar with average true range?
Familiar with what?
Average true range,
No,
ATR.
no.
I'm going to switch back to the chart and I'm going to show you that. Because everything is based upon, we do analysis on the chart. We don't analyze options, we analyze the underlying instrument we're trading, and then we use options to trade it. So I'm going to take this as an example here. On the chart is an indicator buried at the bottom here. It's just a line, you don't see it, but it's the ATR, average true range. ATR.
Is this that blue line?
No, it's on the bottom of the chart. You can't see it. It's nothing.
Oh, the bottom of the chart, yeah.
It's just there.
Yeah.
But it doesn't. So it doesn't. But I don't want to take up space because it doesn't mean anything. It's just there, and the information is what we need. The ATR. ATR is a measure of volatility. We place profit objectives based on volatility, not on option volatility. We don't analyze options. We do it based on the volatility of the underlying ETF. So what this is telling me, on this day, we have a valid trade signal, okay? The ATR that day was $3.71. With that information, how all of our strategies are set up, we know that 84 to 90-something% of the times we get this trade valid on the Qs, that the Qs will open the next day and go up at least $3.71 within the next 1 to 2 months. That's all we know. Realistically, most of the trades will take between 1 day and 5 weeks. But what we know, based on this particular strategy, with this particular set of technical criteria, and we go through it, all the ETFs and hundreds and hundreds and hundreds of trades, going back to 2003, we know when we have this specific set of criteria, the setup and the confirming triggers, that 84 to 90-something% of the time, the market will go higher by the ATR value of $3.71. Sometime within the next.
Did you say APR value? What's that?
The ATR, the average true range.
Oh, average.
On the chart here, ATR.
Oh, okay.
So the ATR changes every day. On this day, the ATR was $3.71. So based on the ATR that day, that is going to be how big a move we expect, minimally, in our direction, which is up. Okay, so someone get a calculator, Becky or anyone else. The next day, the market opened, see the open price up here on the data box. The next day, the market opened at 340.36. What is 340.36 added to $3.71? So 340.36 added to 3.71. What's that value?
Let's see.
And type it into the data box, or excuse me, chat window. The 371 plus 340.36. Someone, Becky said 344.07. Okay. So on this day, we have our valid trade signal. We have an 84 to 90-something% historical win rate. Historical win rate means 84 to 90-something% of the time, it will move at least one ATR higher within the next 1 to 2 months.
And what's an ATR again?
the average true range, and that's a measure of the underlying volatility of the underlying instrument. How we use a 5-period ATR, so it's telling me, that number tells me on average it moves $3.71 every 5 days. That's what it's telling me on average. At this moment in time, that's approximately how much it's moving, 371 every 5 days. So our targets are based on volatility of the underlying, not on the options, on the underlying.
Yeah.
So the next day when the market opens at 340.36 the next day. When the Qs are at or below the open price, I am going to buy the first in the money option, in the money call option. It'll either be 1 expiration cycle or 2 expiration cycles out, depending on the statistics, which we have in our trading plan. So we buy an option. The option is now sitting in our account. We have, let's say we bought 1 call option. We have 1 call option sitting in our account. We then put in an order to sell, to close 1 contract when QQQ reaches 344.07. When the QQQ reaches $344.07, my order will automatically execute and sell to close my option contract. I don't have to look at the computer. I don't have to sit there every morning. I don't have to do anything. I place the order. I walk away and let my money do work for me. I did my work to find the trade and to place the orders. Once I do that, I'm done. There's nothing else for me to do, unless I want to manage positions and trail stops on remaining contracts. Okay. And this trade reached the first target within 2 days. Let's see, 340. Yeah, within 2 days, it hit the first target. A move like this, the trade value of this day.
Which line represents the actual value of the value of the trade?
The candlestick is telling me the open, high, low, and close, the price of the Qs. So on this day, the high was 344.52, which means it went higher than the target of 344.07. So on this day, the first target was reached, because the target is 344.07, and it was reached 2 days later. A trade like this with a 1 expiration cycle option would produce probably a 20 to 30% return at the first target. A trade like this with a 2 expiration cycle probably produce about a 15 to 20% return, because there's a high upfront cost, especially when it moves this quickly. Any questions on this so far? This is how we approach every trade. So ask questions here. This is representative of many trades. They all kind of work the same way. All right.
Yeah, so question here, you mentioned about the blue line going over the orange line.
The orange line crossing above the blue line.
Okay, and you said something about number of days before underneath the blue line.
Correct. So when we go through the detailed trading, you don't have the detailed trading plan. Detailed trading plan has the details. That's for my coaching clients. So I just have a general trade plan right now in the handout. The details, there are more details. There are more details. So this is a very specific number of days. I'm showing you the concept. The details will be in a trading plan for the people I'm coaching. That's where the details are. But it's not just cross above, because if you were to see this orange line cross above, cross below, cross above, cross below, that's a sideways market and we don't touch it. Okay, So we want to see a nice move like this, where it's not just chopping sideways. We want to stay away from choppy markets. So by having a set number of days that it has to be below, it'll look like this. It'll look just like this. It'll come down and up, but not going up, down like that. That's what we want to avoid, because that's more choppy market. So most of our strategies have a set number of days, whether it's futures or options. They have a set number of days before we see crosses to avoid choppy markets.
So you mentioned though some minimum number of days it has to be maintained. It has to be below the crossing. And what was
That's
that?
correct.
How many was that?
That'll be in a trading plan for my coaching clients in detail. And it's different for different strategies. So different strategies, different numbers of days. I think this one for the Donchian is probably 8 for the Donchian. And then the stats in the trading plan will give you win-loss stats for 1 expiration cycle and win-loss stats for 2 expiration cycles. I'm going to show you where the difference can be. I'm going to switch back to the trading plan and show you
And by the
why.
way, what's the time scale? Is each one of you have one of those candles for each day, right?
This is all daily, yeah. So every candle is 1 day.
Okay.
I'm going to switch back to the trading plan real quick and show you the importance of knowing how much time to put into the trade. So you see, here's an example of XLB. Whether it's 1 expiration cycle, 2 expiration cycles worth of time, it doesn't really matter. When you're over 90-something%, it doesn't really matter. You can go 1 expiration cycle because the options will be a whole lot less expensive. The further out you go, there may not be options available. You may have to actually go out 3 expiration cycles because there may not be any options available 2 expiration cycles out. They haven't been created yet. And the more further out you go, the more expensive the options get. And the more expensive the options get, just buying options, expensive options, and trying to expect it to be profitable isn't a good idea. You're going to get killed in time decay. And even if it's a winning trade, instead of being a 20-something% win, it might be a 3% win. So you're tying up capital for no good reason. But here's an example of IBB. Here's the difference in 1 expiration cycle and 2 expiration cycles. You allow 2 expiration cycles worth of time with 93% wins. If you only go 1 expiration cycle, you're 80% wins and way below our threshold. And this is a mistake a lot of people make, especially newer traders. They don't know how much time to allocate into an option when they just buy options. And they end up with time decay losing so much of the value that they take losses and they get discouraged with buying options. There's a time to do fancy spreads and there's a time to just buy calls and buy puts. This strategy, do not try to trade spreads on it. Do not try to trade spreads on it, and do not try to trade spreads on it. This is meant for just buying calls or buying puts. That's it. Attempts to complicate this can result in great losses. Okay.
Now, how is it? I'm confused when you talk about doing 2 options, 2 cycles. I mean, the option dies at the end of 1 cycle. So how is it? But you're talking about going.
Because we're not holding until option expires. We're holding until it reaches the first target. Like the first trade we looked at, it was 2 days. After 2 days, the trade's over. You place an order to sell to close the position when the profit target is reached. The profit target was reached in 2 days for the last thing we looked at. So that was when the position would be closed with a 20-something% return.
I see that sort of, but you talk about 2 expiration cycles and 1 expiration cycle.
Well, you have to know which option to buy. So you have to know which
so
option
they
to
have
buy.
special options that go twice as long as the normal option.
No, you have to, if we're buying one for, if we're buying one expiration cycle out right now, that would be a February expiration. If we're buying 2 expiration cycles out right now, that would be a March expiration.
Oh, I see. So you can buy options to go out further.
Yep.
Okay.
Not every month has options available.
Yeah.
So it may, the plan may say buy 2 expiration cycles out, but when you go 2 months out, options don't exist yet. So then you have to go 3 months out to find, so at least 2 months. So you go out 3 months, but then it starts to get too expensive. And when you're working with me, I will show you how to determine what's too expensive. We have a very specific criteria, and that criteria is based on placing thousands and thousands of live trades. It's not stuff you see in a book. It will not exist in any books. It's just stuff we learn from placing thousands and thousands of trade. At some point, if you pay too much for an option, you're not going to make any money. It'll either time decay against you and you have a guaranteed loss, or like I said, you're going to hit your first target, but you might get a 2% return rather than a 20% return because you paid so much upfront for the option.
I get that. The one thing though that I'm still a little hazy on is, so what is the definition of a cycle?
From Monday after expiration Friday until the following month's expiration Friday.
Okay.
That's literally one cycle. So the expiration Friday is the 3rd Friday of each month. So from the Monday after that Friday until the following month's 3rd Friday, that is one full cycle. So if the plan says 1 expiration cycle, that is literally the minimum amount of time I need in the option life. And that for this IBB, it's telling me that's not enough time. If I want to trade IBB with this strategy, I cannot do it with 1 expiration cycle worth of time. I will take too many losses. You can literally just look at the chart and see the extra red zeros. Those are all losses. These are all losses that would come up with 1 expiration cycle worth of time. Take a look in the column next to it with 2 expiration cycles. A whole lot less red. This is what Becky maintains every month for each of the 28 ETFs we have, plus the futures contracts we trade. I do not put numbers and letters into little rectangles. I will not do that. I have a bunch of Post-its and actual paper and pen on my desk. That's where I document my trades. It's all written out, you know, it's all detailed here. Here are my trades, all here on paper. All the entry, exits, everything. Becky does all the data management. That's what she does for a living. She is a database manager. She manages information. So we work together really well like that, where I do the technical analysis and then we'll go through it together and verify everything works really, really well. And then she documents everything, maintains the stats, but this is what we need for our trading. And then for people I'm coaching, we make this available to everyone I'm coaching at no additional charge because we have to do it for ourselves anyway. So, and we update these stats every 3 to 4 months. And realistically, they don't change all that much. So we know if we see IBB come up valid, it's 90-something% wins with 2 expiration cycles. That's how much time you need in the option. There's no guessing. And when we look at 2 months out, if we determine the option is too expensive via our criteria, we pass. Realistically, there are anywhere from 20-something to about 50 or 60 potential trades each month with our grouping of strategies. This Donchian strategy is just one of 6. So we trade them as a group. To understand that, I'm going to show you the spreadsheet with the trades. It's on our website also. I'm going to change shares here. Trades. Okay, you should be seeing a spreadsheet now. That is all the trades from 2021. These are all the markets we trade, whether it's the Dow, Hong Kong, China, biotech, Russell, silver, NASDAQ. But this is the grouping of ETFs we trade. And the sectors. The reason we trade ETFs rather than stocks is because of implied volatility. The implied volatility on the ETF is a lot lower, and that allows us to be able to buy just calls and puts in a directional trade very confidently that we won't get like a volatility crush one day and just destroy the price in our options. That can happen quite often in stocks. We don't see that in the ETFs. If we trade an ETF in these directional trades, on a winning trade, we expect anywhere from a 3% return to a 30 to 40 something percent return. And that's just at the first profit target. If you do trailing stops, so on and so forth, then that can get up to 60, 70, 90% returns or more. That requires more work. But this is a group of ETFs and sectors which we trade with the ETFs. I always tell people that the most profitable time to trade is October through April. Reason is we get the biggest trends, whether long or short, we get the biggest trends from October through April. And so when we get those moves happening, it's just sweet trading. So if we take a look at our win-loss status for the last few months, this is the trade. These are the different strategies we have. We're going over the Donchian Cross today, but there's 6 strategies total in the daily grouping of strategies. These are all the different charts strategies we trade, and long and short. And you can take a look at the wins versus losses. Where the losses? It's November, no losses, no losses. This is going back to October, no losses. Last set of losses were in September expiration. Then before that, very, very, very few. But October through April is when we see the biggest profits. That's when I always tell people, no matter what you do, trade October through April, no matter what, because we get trends going up, we get trends going down. This last week, all of our put trades were hitting targets, just down, 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 everything hitting the last 2 weeks. So when you see the update for the end of January that Becky will do, you're going to find a whole lot of short trades hit first targets. A lot of short trades hit first targets this month. And that you will see when in the next update for at the end of January. She updates this at the end of each month. That's why you don't see the January trades here. And if we're just talking purely Donchian, this is more than just Donchian. This ETF strategy is not a Donchian strategy. But this is the one that hits all market tops. We catch all market tops with this strategy. All market tops, whether it's futures or it's options or stocks. This is the strategy. This is the strategy we use for market tops. Period. You go through any point in time, whether it's 2008 or 87 or whenever it was, or 2015, whenever the market just got crushed. It all starts with this sell signal. Okay. Even last year, this was the sell signal that made us the most money. In February and March of 2020, 2 years ago. This is the one that made us the most money.
And what is that sell signal?
That is a squeeze signal, and it identifies market tops. It's one of our 6 strategies. So today we're going over the Donchian Cross, which is a long strategy, but that is the one for market tops, specifically for market tops.
Oh.
Because literally every market will, on a decline, will start with that signal. So if you're consistent with it, it's like, it may go against you once in a while in a bullish market, but then when it hits big. I mean, real big. And this is the Donchian only strategies. So not counting the one I showed you just for just the market top, this is only the Donchian. So 4 out of the 6 strategies are Donchian strategies, okay? So I asked Becky to put together this list. This goes back to 2019. And then from 2019, literally right through now. She actually updated this right through this past week. So there were some extra trades. So she updated it right through Friday, basically. These were all the trades valid through this past week. and for those of you who are familiar with the strategies, this listing also includes the ones that are under 84%. So including all the ETFs, even the ones under 84% combined, it's 800 and something trades, and 90% of them hitting the first profit target within 2 expiration cycles. Okay. This is how we know we make money trading options, by maintaining these lists for every ETF. So even there are ETFs here that by itself may only be 78%. But if you look at it from a big picture point of view, trade them all as a group. I've told some people, it's like, not everyone can trade DIA, because DIA call options are going to cost $1,000 to $1,800 for one contract. It's out of most people's price range, because that has to represent 2% of the account. However, they can trade XLI. XLI is like the little brother of DIA. It's 1/2 or one. It's 90 something, about 93% correlated with the Dow. It is the industrials, and it can be traded in place of. So not everyone can afford DIA. It's just too expensive.
So if you can't afford the DIA, does it give a higher return or something, or why bother with it?
No, it's just literally, it just costs too much. The option itself literally costs $1,000.
No reason to bother with it then. Yeah.
If you have let's say a $25,000 account, one DIA contract might cost you $1,400, which is 3 times bigger than you should be a trade that you should be taking.
Yeah, but if you did have an account that could handle that within 2%, would there be any reason to do it, or you might as well just use?
Oh yeah, you do it as long as you can afford it and the stats look good. Yeah, take that trade. Absolutely. As long as you can afford it and the stats are over 84%, take that trade.
So does that give a higher return then, are you saying, if you can afford it?
No, no higher return. They're all the same.
So why would one bother with it? Why not just stick with the lower price ones?
Because what the big difference is, DIA has more volume, more open interest. So your bid-ask spread is going to be pennies wide. XLI isn't, the options are not as heavily traded. So it has a lower open interest and the spreads might be wider.
Don't you make more money percentage-wise? I mean, the same money percentage-wise, but it's a bigger amount, right? Because percentage-wise, because if you make 5%, I mean, if you make 20% on $100, it's that, and 20% on $1,000, it's you actually make more each time on the $1,000.
It doesn't matter what size the account you have, the percentage doesn't change.
I understand the percentage,
yeah.
But I'm saying that if DIA costs I'm going to say $2,000, I'm going to say $1,000 to make it easy. If DIA costs $1,000,
and XLI costs $500,
and XLI costs,
let's say about half, at least half.
Okay, and if you buy one XLI and make 20%, you're going to make what's the one, DIA, and make 20%, you're going to make $200, whereas with XLI you make $100.
We want to keep it to percentages. We want to keep it to percentages rather than dollar amounts, because you can't talk dollar amounts. Everyone has different size accounts.
What I'm saying is he's asking you why anybody would want to buy DIA instead of sticking with a smaller.
Oh, it just has more volume, massive volume. The bid-ask spread on the options are tighter. You don't get a lot of slippage on the way out. And I know you've experienced slippage, right, Connie, on the way out, where you got kind of screwed on the way out, right?
Right.
Exactly. You don't get that with DIA because it has such massive volume. Even on a gap, instead of having a 3 penny wide spread, it might be a 10-cent spread.
Hmm.
And XLI that has lower option volume will have a wider spread, and you might give some money back on certain gaps at certain times. So if you have the capital, it goes back to the old, if you have more money, you can make more money than someone who has less money.
Oh, you can make more money percentage wise, I mean, yeah.
You can, percentage wise, they should be about the same, except if you have a choice of buying 1 DIA contract or 2 XLI contracts, at the first target, they might be equal. But if you're trailing stops, you can stay in that second half of XLI longer and trail the stop. XLI, because quite literally one DIA contract is like 2 XLI contracts, price-wise. I would rather have more contracts and be able to stay in a position longer by trailing my stops on the second half than be total and be out of 1 contract in the first target and be done. Having more contracts is better than having less. It all depends what you can afford and your size account, and whether or not you want to trail stops or not. Some people don't. So there's something here for everyone. Most of the options are going to be realistically cost between $2 and $4 something per contract, realistically, in most cases. During super high volatility, the 2 something contract might cost $4 and the 4 something contract might cost $8 during super high volatility. But generally at most times it's between $2 and $4 for most of these option contracts. SPY, DIA, and QQQ are the expensive ones.
You say that's between $2 and $5. Is that per option, but you have to buy 100, or is that?
No,
the
you
actual
gotta, that's per contract.
for the-
If you're spending $300 per contract and you risk it $1,000, then you can afford 3 contracts. That's what you're gonna be trading. It's all based upon what your established risk per trade is. So if you're risking $1,000 and each contract costs $3, which is $300, then you can only buy 3 contracts. If another trade is valid on XLI, and XLI costs $500 a contract, and you're risking $1,000, then you can only buy 2 contracts for that particular trade.
Yeah.
But you keep all trades in that same dollar per risk neighborhood, and then you can actually have predictable results. So since March 2020, okay, I'm someone who has multiple streams of income for all the different things I do. I also teach fitness classes. I'm a contractor at Apple, at Google, NVIDIA, Adobe, Santa Clara University I teach. Literally all those incomes have been shut off since March 2020 with no plans to resume at least until March 2022. The one income I've had consistently and extremely high since, even better than ever, has been trading. Trading actually got better. Trading got more profitable. The most profitable trading was last year, February and March, 2020, February and March, when the market got crushed with the COVID shutdowns. This is the one thing with all directional trading. So we're not limiting our profits. I remember Connie, you were in some of these trades when the market dropped along with some other people, and you're wondering, how can you stay in, get in any more trades because you had maxed out all your puts and you're already out of them. It's like, now what? You gotta wait for it to go up again. That was just some great trading. The market dropped, everyone was making money on the puts all the way down because we had our sell signals. But that's what we do. We just take our directional signals as they come. You can see these were the trades. This is a massive bullish move on multiple markets in 2019. Massive bullish move. And that went on for a while. And let's take a look at some of the recent trades. Let's see, 2022. We had a crossover buy. I think I'm going to change charts. So you have this, see, this is on 110 SPY. and 110 USO, crossover long, SPY and USO. I'm gonna go back to the chart. I'm gonna change the share. Take a look at those. Okay, go to SPY, recent trades. Okay, here is the trade signal. Orange line crosses the blue line on 110. The ATR that day is $6.07. The next day, the market opened at $465.23, $465.23. When SPY is at or below the open. Now when it's up here, when it goes at or below the open price, we buy in the money options, the first strike in the money, either 1 or 2 expiration cycles out, depending on the stats. Trading plan will have the stats for 1 expiration cycle. It'll have the stats for 2 expiration cycles. You make a choice. And then once the options are in your account, you place an exit order to automatically sell your contracts when XLI, the next day. Becky, what is 465.23? So Becky, calculation for me. What is 465.23 added to 607? So the open price the next day is 465.23. Again, 465.23, and add to that $6.07. What's that price? Open at 465.23 and add 607 to it. 471.30. So we put our order in the very next morning. We've just bought in the money options. We place our order to sell so many contracts when SPY goes above $471.30. That first day we're in the trade, the high was 469.85. It didn't hit our first target. The next day it gapped up. It actually gapped up beyond our first target. Cha-ching. Gaps are great for us because there's more profit than expected. After it gaps up, our order automatically executes. There's nothing for us to do. The order automatically executes. It puts money in our pocket. For the people just trading first target only, there's nothing, the trade's over, they're good to go. For people who are trailing stops looking for more profits, what they do, they sell half their position at the first target, and then automatically, and then on the second remaining contracts, you put in an actual stop loss. If you paid $8 for the contracts and it's now at 10 something, then you're going to put in a stop loss somewhere between 8 and 10 something. The lock-in profit. If you paid $3 for the option and then the option now costs $4 at the first target, then you're going to put in a stop loss somewhere between $3 and $4 to protect the profits. And that percentage, I work with you to determine what percentage is good for you. I usually recommend at least, well, it depends what option the futures are different, but at least 20-something% profit up to lock in, and then go from there. Because you're going to change how much you protect based on your personality and your financial situation. If you need the money, then you will lock in more of the profit. If you don't need the money right now, then you should lock in less of the profit and try to catch the bigger move. And some people don't want to give back any money, so they just put a really tight stop and see if it keeps going. Okay. And what was the other one? Was it UNG? Or USO? USO on 110.
So what's the USO?
US oil.
Oh.
US oil 110. Nice big move. So we had the crossover. Orange line crosses the blue line. Close below the Bollinger Band. Lots of days below orange line, below the blue line. Lots of days. The next morning, the market opens at the ATR that day is $1.14. The market opened the next day at 56.95. 56.95 added after that $1.14, that's the first target hit within a day or two. And then you keep trailing the stop up. This is a kind of trade where if you stay in, you're going to double your money on the second half. And then if you're trading thirds, this can keep going and possibly triple, because it went, you got to the trade, it went up, hits your target and never pulls back to stop you out of the remaining contracts. So if you're trailing your stop, as the market keeps going up, you keep moving your stop loss up. Your first target is 1 times the ATR, but the second target is 2 times the ATR. So you're looking for an even bigger move. Excuse me. Your second target is 2 times what you paid for the option. Second target is twice what you paid for the option. You're looking to double your money on the second half. This happens several times a year. You catch a move like this. If you paid $3 for the option, you have a second target of $6, and you just trail your stop up until it hits $6 or until your stop is hit. Where you just keep protecting more and more profit. If your stop loss is right here initially, let's say right here, as you keep trailing it up, you lock it in more and more profit, more and more profit. The option's getting more and more expensive as you lock it in more and more profit until either the second target is hit or your stop loss is hit. That's what I mean about the extra work. If you're willing to put in the extra work, it will pay off and you will make more money in the long run. If all you want is the first target, then you do minimal work, put in your order, walk away, go live your life. Either way is fine. Since this is truly a business, if you more time and effort you put into your business of trading, you will see the results. You will truly see the results. But not everyone has the time and effort to put into the business. So you will see that you'll see a good 10-20% return. And some people are quite happy with that, because the 10 to 20% return is way better than what they used to be having, which is losses. Doesn't matter if the market's going up or down, the strategies work the same way. It's a matter of being consistent, showing up every day to run your business. It's like any other job, any other business. It's your business. No one else will run it for you. And it's something you do by yourself. Luckily, we have our trading group. I'm going to switch to the website real fast to show you that. So I'm going to change the shares right now. Back to the website. Okay. This is my website. Here on this site, we have all the handouts and the spreadsheets are here, trade history. There's also the video for the futures. I'll send, but Robert, email me later. I'll send you the same link unless you want to watch this one. This is a different one. This is an earlier video. I have a more recent one from 2 weeks ago. The one from 2 weeks ago is very up to date. This one's good too, but the one from 2 weeks ago is very, very, very up to date. But our
So
Facebook
best
group,
off just watching the latest one, is that what you're saying?
yeah, the latest one. I'm going to.
I can't see what I downloaded. It's either sort of watching you in real time or looking at that site. So
this is our Facebook group for the option trades, and we post the option trades in this group to see what's valid any given particular day. I'll post some of the futures trades in here too. So we place different. So every day, every evening, I place what's valid in here. These are all the short trades that were happening over the last couple of weeks, and they're all hitting now. They're all hitting. So hopefully people got into them. And then we have the second page for the futures. So 2 separate groups. So this is the futures. This was a nice week for shorts on the indices.
Eversley, did you talk at all about all of the trades that expired on Friday?
I will not even see them until Becky updates them. I couldn't care less what expired on Friday. When Becky does the update for next month, then we'll take a look at them. Is there something in particular you want to look at?
No, Nothing in particular. I just had a lot of ones that went south for me.
Pick one.
I'm still up, but
Yeah. If you're trading futures, cha-ching. If you're trading ETFs
No.
options, it depends which ones and which choices were made. If it's the one you want to take a look at, just to make sure everything was okay. And if it's a valid loss, great. If it's not a valid loss, then we can take a look at it and see. As long as it's a
EM,
valid loss, it's great.
off the top of my head, EEM.
EEM, that one just went down. EM just plain old went down. Even EM, I think it's just a loss. Probably valid back here somewhere, maybe.
A couple of months ago.
Yeah, I think that's just a loss. Yeah, EM is just a loss. Remember, you're gonna have 50% losses. So long as you, since it's purely a statistical thing, as long as you are placing 10 to 15 trades a month, you're gonna make money. For every 20 trades you place, 3 will be full losses. For every 20 trades you place, 3 of them will be full losses, guaranteed. So, if we're trading 85 to 90 something percent wins, that's what you got to focus, the big picture. You will have at least 3 losing months every year. Even at 85, 90 something percent wins, you will have 3 losing months every year. That's almost guaranteed. Those 3 losing months each year will be negated by 3 winning months each year. Big picture. 3 losing months will be negated by 3 winning months. To get to the 3 winning months, you have to disregard the losing months and keep trading and keep trading, because it's a purely a statistical mathematical thing. You got to place the 10 to 15 trades a month to see the numbers work out, and you have to get through those 12 months. And at the end of 12 months, I challenge anyone to tell me they lost money that year unless they made a bunch of mistakes or didn't get their trades placed. Because show me you had a losing year trading these strategies, and it's basically impossible unless you are making a whole bunch of mistakes and I don't know about it. You haven't told me what you were doing. And I know people who do that. And then, you know, there was one person and he was losing money every which way. And he thought it was the strategies and I sucked, basically. Yeah, but he was cool. He talked to me and it's like, yeah, your strategies don't work. I'm like, what do you mean they don't work? And then he said he got all these losses. And this is one of my coaching clients, but he stopped communicating with me because he got all these losses, got mad. He figures, oh, these strategies don't work at all. He got to ready for months. He just kept losing money. Okay, so I found, okay, dude, like, show me what you're doing. And he was totally managing it incorrectly. What he was doing was he wasn't putting in his stop loss on the second part or third part of the trade correctly. And he was trading thirds, first target, second target, third target. So after the first target was hit, he didn't move his stop loss up on the remaining contracts, and then they would become full losses. So he would take a full loss. He would have like a 20% win and then 80% loss on the remaining contracts, because he just totally missed it. When I told him, dude, like, what do you want? It's like, oh crap. It was literally, it was one of those things, you know? And that is why I encourage people to, number one, Becky updates the trade listing every month, and I post it in the group and I post it online. Go through the trade listing and see if your wins and losses are significantly different than what you see. There'll be differences, but they shouldn't be significantly different. If we show 1 loss and you have 7, then there's something really wrong with what you're doing, and we need to look at it. So I offer people, anyone I'm coaching, to review their trades with them at least once a month. There's no additional charge for that, and there's no time limit. It's like, if you got something ain't working, let's take a look at it and try to figure out what's going on, because your numbers should look like these. Okay, I'll give the other sheet, which is the current thing. If your numbers and win-loss don't look something like this in the last 2 months, then we need to take a look at what you're doing. Should you get some January losses? Maybe, because we haven't had losses. We literally haven't had losses in months. We may get some January losses. But then after that, win, it just picks up again and starts over the routine. So you may have a losing January, which will be negated by a winning December or winning February, that type of thing, and just keep trading. And that's how we do it. We just keep trading, and as long as you're getting in at least 10 to 15 trades a month, you're good to go with the options. Some people trade more, some people trade less, but really try to get in. Since it's purely a numbers thing, there's options. Not every option is tradable. You're going to get something, you're going to look at it, the options just don't have enough open interest, so you're going to pass, or the bid-ask spread is just way wide, you're going to pass. But even those where the option open interest is low, or there's a wide spread, there are other opportunities to get into trades. That's what we go through also. There's more than one opportunity to get into trades other than the next day. And you can get some, like most of my trades, my option trades that are winners, I pull in a 30 to 60% return at the first target, because I get in at a more optimal time. I do not get up in the morning to place trades. I am very relaxed because I've been doing it for so long. I do not get up in the morning to place trades at all, ever, anymore. Right.
Oh, wait, aren't you say you don't get up in the morning? You mean you start trading late in the day?
No, I place my trade either in the evening or sometime next day or the next week or whenever. I don't stress over it. There's so
I
many
see it's
trading
there, you know it's
opportunities.
going to work in the long run on
Yeah,
average.
it's just we have the stats. All we care about is the stats. So I know how to set up a trade so that I don't have to be there at the open. It'll either fill or it'll bounce around for a while, and after I get up, might adjust the entry price, the limit order. I'm not going to be up at 6 something in the morning looking to fill any trades. The people who are up in the morning, there are some people in here who get up in the morning and they do it, and that's their routine, and it works for them. I'm not one of those people. There's some trades I really want to be in. Then every once in a while, when those come up, I will get up just to check where the market's at. I usually look at the futures to see if the market's going to be gapping or not. And then I adjust my pricing accordingly. But most of my trades are either set up the evening before with limit orders, or they are set up after I wake up. And I found over time, the more relaxed you are at placing your trades, actually, the more money you end up making. If a
So
trade
you're saying
goes,
you can do this trading anytime during the day?
yeah, if it does, let's go, staying on the chart. Let's go back to the recent trade on SPY. Okay, I pull up the SPY. Okay, the market opens right here, right? And then drops. This market could have been down for 2-3 hours. Anytime during this time you enter the position. As long as the market is at or below the open price, you get in. If as long as the market is at or below the open price and the first target has not been reached, get in. Go back a little bit. I'm gonna find a different example. Okay. Okay. Here is a great example. Not a great example. Hang on.
So basically,
Okay, here would be a good example of getting in late. And the later you get in, the more profitable it becomes. Here's the signal. Orange line crosses the blue line, right?
Yep.
This is SPY. ATR is $5.06. So that's how big my first target is, $5.06. I don't rush to get into these trades. I am very relaxed. My money between options and futures, most of my option trades, for my futures trades, it's going to be the indexes, Dow, S&P, NASDAQ, and Russell 2000, and currencies, Australian dollar, British pound, euro, Swiss franc, and something else. Euro, Swiss franc, and something else. For everything else, I use options. For oil, gas, silver, gold, energy, I use options. But this would be an example. Got a valid trade signal, over 85% wins. If I'm going per plan, I'm getting up in the morning, then I'm getting in right here. And then it goes against me. I can enter this trade here, or here, or here, or here, or here, or here, or on this day. I just have to enter the trade at or below this open price the next day and before the first target is reached. Here, if I enter here, my first target is $5.06. Let's say it drops down to, it goes from 349 down to 335. On this day, I was looking back, as this is literally how I trade, and Becky does the same thing. I missed this trade that day because I was doing other things, taking other trades. You can only play so many trades with so much capital because there are 60 trades a month. You can't take every trade. So you see, I missed that trade that day. But so you're looking over here, what trades did I miss that I could get into after this pullback? We were looking back and saying, hey, there was a trade valid back here, which we never took. So this day, the market's at 335, so I want to buy some 335 call options. But I am now literally $15 lower than my entry price would have been initially. So instead of having, but my target is still up here. So instead of having a $5 target, maybe I want to have a $7 target now, or $10 target. So I get in at a better price. Now I have more flexibility on how big a target I want. Suddenly, instead of expecting a 15, 20-something% return, I'm getting bigger targets. I'm getting deeper in the money because I'm still buying into money options, but I'm getting 10 points in the money. I'm getting a 50, 60, 70% return at just the first target because I'm getting in at a better price with a bigger target. I have more subjective flexibility on target price because I'm getting in lower than expected. My target is still 5 points above this level, but I'm getting in 15 points lower than expected. So I have 15 points plus the initial 5 points to work with. So I have 20 potential points get to my first target. The same probability of success. The probability of success is still 84 to 90-something% wins. That hasn't changed. It's that I'm getting in a better price. This is something Becky does all the time. I do all the time. Most of my index futures, index option trades are like this. I get in after a pullback because of my futures trades, I'm getting in when I should be. But for the option, I just wait for a pullback, or if I miss it, I miss. I don't care. There are many other trades I'm taking, but I look for these that I've missed for whatever reason. Getting in here, it was too expensive, not getting in. But down here, option is so expensive, but my target is bigger, way bigger, so it can compensate for the expensive options. A lot of stuff there to like process, but that's stuff we work on one-on-one with people I'm working with, how to maximize their profits and just be real relaxed in trading. Don't stress to get into a trade. There's so many opportunities to get into a trade and so many trades. You can't take them all. Any questions on any of this so far? Because we're covering a lot of stuff here. But any questions? And note, we haven't been doing any option analysis. There's no option analysis here. It's the first in the money option, 2 to 3 expiration cycles out. And when I work with you in the actual coaching session, then we'll go through how to determine option pricing, what is too expensive, and that type of stuff. You don't have to, need a general understanding of the option Greeks, but you don't have to know all the details. It's a general concept. of what delta is and theta is. That's really all you need to know, generally what that is. But you don't have to know anything beyond that. You don't have to know all, we don't get no risk graphs to analyze, because we don't analyze options, we analyze the underlying, way easier. When I first started trading, I started this area in the South Bay in Silicon Valley, where all the people that were around me are like engineers and scientists and people with degrees in math and science and programming. And there's a tendency for really smart, educated people in sciences and engineering and math to favor stuff that was complicated and required understanding of high school and college level mathematical principles. That's all the option spread stuff. The rest of the country isn't like that. When we started, myself and Becky went to trading conferences around the country. We met people who trade their own strategies, their own money, not schools, and you meet different people who are not engineers and scientists. They can't do all this option spreads. That's just way complicated. And we just met so many people. Our whole viewpoint approach to trading changed to be more directional, a lot more simple. If I need to do something that requires more than a 4th or 5th grade education in math, I will not do it. It's just, I've just grown so much from that. I look back at some of the stuff I used to do on options. I'm like, no way I would ever contemplate doing that ever again. And no way I could even teach it to someone else, because it takes years to actually learn it, implement it. And then if you have enough, you then need a boatload of money to actually make enough money to make it meaningful. And meaning, if you're doing complex spreads and the market goes against you, you have to put more money into a trade gone bad to keep it from going worse. And then if the trade keeps going, if that trade goes bad, you got to put more money in to adjust the adjustments. And that whole concept is just, no way I could do that as someone's going to be self-employed as a trader with a limited pool of money to work with since I left my full-time job. There's no more putting more money into money, save money gone bad. That's ridiculous. So I don't, with the directional trading, I don't limit how much I can make, and I limit how much I can lose. So if I know my loss is $1,000 a trade max, and I know I expect to make 10 to 20% return annually at the first target only, I can put together a plan to make that. If I know that if my trailing stops, I can make 30, 20 to 40 something % return annually on my account, I can do that because I have the plan, I have the stats, it's all numbers. Like I said, with futures, it's easy. Futures is easy. It's a 30 something to 50 something % annual return, and the video will show you that. Let's see if I can pull that up real quick before I forget. Let's put that into the window so you can take a look at the video. I did. Some of you have seen it. Let's see, download tutorial. Let's see, it's also, let's see, updated futures. Here it is. I'm going to put it into the chat window. Then you can probably go take a look at it.
Wait, what exactly is this you're putting in the chat window?
That is the link for the futures meetup from 2 weeks ago.
Okay.
That will give you a really, really clear, concise understanding of profitability. I literally went through a month-to-month profitability review from 2019 through now. To see what the numbers look like when you take all the trades, and the numbers are pretty damn accurate. Okay, if you keep risk around a certain dollar amount and the percentage returns, really, really accurate. I take every single trade that becomes valid. Personally, I take every single trade, but that's the link. You can take a look at it.
So it's a January 9th meeting. All right, let me near that. Okay.
Is Donchian, question from James, is Donchian SMA cross a reversal strategy? it's usually one of the first trade signals you see after a decline in the markets, and that's including if it's in a trend. So market's uptrending, but it pulls back in the uptrend. So the
Wait a
chart
minute, I
here.
seen it got.
So the market's in an uptrend, it pulls back. I'm saying uptrend with the 40 period moving average going up. That's how I'm saying uptrend. Market's in uptrend, but there's going to be pullbacks. Next buy signal right here. Okay. Uptrend, market pulls back. Next buy signal right here. Next buy signal right here. So it's both trend and pullback. It's not a reversal, so to speak. It's just re-entries into a trend, or it's just a great setup. That's what can I say? It's just I first learned about the Donchian Channel from Steve Primo. He showed one of his strategies using Donchian. This is not his strategy in any way, but it made me start looking at the Donchian Channel and how to use it and incorporate it into the way we trade. And it just opened up doors and ended up creating these 4 strategies for the Donchians, and it just works so well. Just works so well. Why do you use 40 SMA? We use 40 SMA because years ago we met Oliver Velez. Oliver Velez used the 40 period SMA in pretty much all of his strategies. So we started using a 40 period SMA as a way to identify trend, either above or below the 40, or trending up, trending down. And when we incorporated that with the other things we were doing, it has become a staple in all of our strategies, that 40 period moving average. So you will find a 40 SMA on all of our charts as a line in the sand to establish trend, either above or below, or literally whether it's increasing or decreasing. But that was learned from Oliver Velez, and it worked, so we kept it. If we learn something that works, we keep it. Doesn't matter where it came from. If it works, we keep it. So what you're seeing here is the cumulative knowledge of thousands of hours of work and learning from dozens and dozens of different people. I'm going to switch to a stat sheet real quick, and then I'm going to wrap it up in a little bit after taking some questions. And share. We should be seeing now, these are the sectors we trade again, and give you an idea. This is for our weekly chart setups, weekly chart strategies, called weekly swing. There are 2 setups in the weekly swing. These are the stats. If it's light blue, it means it's 84% or higher. These are different ETFs. With the weekly charts, it means we look at these charts once a week on the weekend, and we place our orders Monday morning. That's it. We place the orders Monday morning. These have bigger targets than the daily chart strategies, but these are the stats for some of the weeklies. Weekly 10.5 buy. It's a bigger picture trade, but it works really well. Not everyone has time to work every day trading because they're busy doing other things or don't want to. So they do the weekly charts only. I'm going to do the weekly charts only. This is what they expect, the same as the daily, except that they're only about maybe 10 to 15 trades a month, but these are the stats for those 10 to 15 trades a month. The T-line buy, this is one of the daily chart strategies, not the one we're looking at now. This is telling you at one expiration cycle, these are what the stats are like. And these are the stats 2 expiration cycles. Take a look at the big difference between 1 expiration cycle and 2 expiration cycles as far as percentage wins. That's why we need to maintain the stats so that we don't just haphazardly go buy long options and they expire worthless. That's the worst thing you do. So that's why we maintain these stats, to know which options to buy and which ones to pass on and how much time we need. Literally how we do it. So we maintain these stats. Another one, T-line buy. This is the short side, similar strategy, short side. If we get a trade value in EM for this short trade, we'd pass. We begin to trade valid on GDX, gold mining stocks. I trade GDX as one of my favorite ETFs to trade is GDX. I'd be taking that trade. GDX is good on every strategy. T-hook. See all the light blue? Those are the ones we trade with. It great strategy. This one, market bottom. This is our favorite strategy for market bottoms. This is an Ichimoku strategy. And this is the one for market tops. This one is market tops. This is the one that was the biggest winner in February and March 2020 when the market just got crushed for several weeks.
Oh.
Okay, I'm going to go back to handout. Time always goes by really, really fast during these meetups. If anyone is interested in learning the strategies, I have 3 programs as far as options go. Everything this is there's really 6 strategies, and everything I do is one-on-one. I don't do big group meetings. I do one-on-one, customized to you, your personality, and your schedule. Everyone's different. I will help you set up the charts in detail on your computer. You can either do it in person if you live somewhere near the South Bay, in the Bay Area. I usually meet people at Santa Clara University most often, but I meet people in person or via Zoom. I'm available by phone also for follow-ups and consultation. And but we meet via Zoom or in person to get all this, to learn all the strategies, set up a computer, and I work with you to get it right, including if you need your account set up. If you're brand new to trading options, I would go with the full options program. This is the one where I will literally be holding your hand. The other program, this program assumes for 1750, assumes that you already know your stuff. You already have an option account. You already have some trading background, some experience. I don't have to work with you on, this is what a call option is. This is what a put option is. This assumes you already know your basic stuff. And we're going to pretty much get right into it a lot faster. But I'm not going to be spending time explaining basics. If you're brand new to trading, I will hold you or hold your hand. I will help you get your account set up, help you with the broker, help you with everything you need to get going. And even if I need to, I will be on a Zoom meeting with you or in person, which I've done in person also. When you are placing your live trade, literally on there, okay, fill the form out just right, go through everything step by step with you, make sure it's right. But this is a lot more strategies. You're going to get a full deal. You're going to get the weekly market internals plus the 6 daily chart strategies. So this is everything. This is one I recommend, if even for people with more experience that just want the flexibility, they want it all available to them. What ends up happening, people will start with the other one, then, we really want to learn the market internals. We really want to learn the weekly. That happens also then. And for this one, for the folks in the meetup, I'll take $100 off this for $16.50. And even going to do the full program, I will take off. If you want to do the full program, options program, I will take $1,000 off this for $29.95. If you want the full option program, $29.95, it's $1,000 off. Let me know by the end of the week. And for people who want futures and options, those are the daily chart option strategies, which we were talking about today, plus the future strategies. There are a lot more futures. There's actually 10 futures strategies, not 7, actually increased. There's actually 10 strategies now and 6 option strategies, $34.95. And I will take $250 off this price. So if you want to do this, $250 off this price, let me know by the end of the week. So
You say $250, you mean?
$250.
Yeah.
I'll take $250 off this price if you want to do both futures and options with me. Just let me know by the end of the week. We'll probably start with futures first because the markets have been dropping, and we're already in all of our short trades for the futures. Okay, we're now waiting for things to turn up and cha-ching for the long trades. So if you're doing the futures with me and options, we will start with futures right away to be ready for that first upturn to ride it back up. Okay, so futures we start off right away first and then go to options second, because the futures will come up first. And we want to ride that baby up because it's so profitable. We don't want to miss out on it. So 250 off of this price.
It seems if
And
we're gonna, is there any reason to do the options? I mean, the futures have a greater return. Any reason?
I
to
would
do
say, I would recommend doing the futures first. And if you
Yeah.
want to add options afterwards, just let me know. Just let me
Yeah.
know. If you're gonna do the futures, it'll be 1745, and I'll give you $100 discount. So 1745 minus 100, so 1645. But yes, I totally agree with you. But some people really, really like options. Some people really, really like futures. And even though I tell them futures can be more profitable, they still, because of their comfort zone, they'll rather will focus on the option. That's fine. Nothing wrong with that. But yeah, the futures is my first choice. I mean, I really, it's just easy.
Yeah. Now, how big an account do I need?
Whether it's futures or options, it would be good to have at least a 20-something to $30,000 account, that 20 to 30,000 neighborhood, to be comfortable. To be comfortable. You can
Yeah.
trade with a small, you can trade options with a smaller account. You can trade with options with a 10, 15 grand account comfortably, risking about 500, 600 bucks a trade. But with the futures, you need a bigger account because of the margin. So the risk is the same as the options, but there's margin on it, so you have to account for margin. So for the futures, you're looking at a 20 to 25 grand account to be comfortable doing all the trades and strategies and not being limited. Realistically, you can trade less, but then you're really going to have to you can trade with a 15, 20 grand account for the futures, but you gotta trade smaller and you won't be in every trade. Meaning the NASDAQ. The NASDAQ is going to be the biggest one. The rest are all okay, but you'll probably be limited when it comes to NASDAQ. You won't be able to take those trades because they require more margin and the stop loss will be bigger and everything will be just bigger with the NASDAQ. Anyway, do we have any questions on anything? Let's see. Does futures include options on futures? No options on futures. That's just a way to take something simple and find a way to complicate it. There are times when you might do options on like commodities if you wanted to swing trade something and hold it. But I can't think of any good reason whatsoever to do futures on options unless you just want to find ways to complicate things needlessly. No.
Already complicated enough for me.
They do options on the ETFs, options on stocks, but for futures are like so efficient to trade. It's like, that's why I just love it. It's just efficient. And when you have the right strategy to capitalize on it, our futures P&L, when you watch the video, you're gonna be like, wow, and it is wow.
Now, one thing I want to ask you, you mentioned these very high, it seems on these trades, very high rates of return.
Okay.
But yet at the end of the year, do I understand you right that basically about what you can expect to make is around 40% in the futures?
That's correct, because a lot of people think about how much money they're going to make, but no one ever thinks about how much money that they will lose on losses.
Yeah.
Yeah, because even at 85% wins, it means you're going to get let's do some quick math let's do some really quick math. If you place 20 trades and risking $1,000 per trade, on 3 trades, you will lose $1,000. 3 trades, you will lose $1,000. That's minus $3,000. On the other 17 trades, you're going to, with the futures, you will average a 45% return. That's $450. What's 450 times 17? And then subtract 3,000 from that. That's the profit. That's straightforward.
Yeah.
That's what 17 times $450 and minus $3,000. That's trading futures. With options, you don't get as high a return. You may get the same percentage wins, but because of time decay, we can't say we're going to average 40-something%. You're going to average, if you're doing pretty well, you're going to average 20 to 25% return on winning trades. If you're spending more time on trade management, then that you can average 20 to 30% return. So it's a
That's a
different
20 to, oh, yeah.
Yeah, so options, 20 to 25% return on winning trades as opposed to 45% return on with futures. So you'll make more.
Yeah.
But with the options, it varies because you literally don't know how much you're going to make because of time decay. You literally don't know. All you know is that it'll be profitable. But a winning trade might be a 3% return. A winning trade might be a 50% return. A winning trade might be a 20% return. A winning trade might be a minus 10% return because of time decay. So when you put all your trades together, it comes out net positive, but you don't know what that number is going to be.
Yeah.
So that's the difference in options and futures. Futures, we can tell you exactly how much you're going to make, but pretty damn close. With the options, as long as you're placing 10 to 15 trades a month, you will make money. And some trades are going to be months will be ridiculously profitable. Like I showed you the wins for the last 3 months, for October, November, December. Those are ridiculously profitable months. And those ridiculously profitable months totally offset any losses you might have in some previous months. Totally offset those. So
But still, at the end of the year, averaged over the whole year, or not average over the year, the return you make, you know, with adding up all the profits and the losses you've made during the year, you just come out with it just comes out to being about a 45% gain
for
in your
the
account.
options, for the futures, that's just the first target. Realistically, after you watch the video, you'll see the percentage returns is annual is more like the 40 to 50 something percent annual. That's just the first target. That doesn't include trailing the stops and maximizing profits. That is just taking profit. All we can show you on the spreadsheet is at the first target.
Yeah, that's just the first target.
Yeah,
But
that's
if you add on a
correct.
stop loss, you don't have to keep following it. So what would be the next level? So if you
Once you get past the first target, you can do whatever the heck you want. You want to protect 80% of your profits, 20% of your profit. Use, as long as your stop loss is above your entry price, you can do whatever you want after that. There are 1,000 ways to trail stops and manage profits. So what we focus on is getting to that first target. After that, there's a lot of flexibility with the futures and what to do next, how you want to protect your profits. As long as your stop's in place, you can have massive targets as long as your stop's above your entry price. That's it. And the same thing with the options. If you're doing multiple targets with the options, once you get past that first target, you're going to put a stop loss in above what you paid for the option. And from that point on, you have flexibility. But since options decay, I just recommend your second target is 2 times what you paid. And a couple times a year, you're going to get doubles and triples.
Yeah. So I'm sure okay. So if you put a trailing stop on there, when you're trading the futures.
Yep.
So what is a realistic return you can get then?
It depends how you choose to
Annualized
trail. No,
basis.
it all depends on how someone who's protecting 20% will have different results than someone who's protecting 80%. That's it. Someone who doesn't want to give back a lot of money will put in a tight stop and they'll get stopped out quickly. Someone who puts in a loose stop might be in it for like weeks.
Yeah.
So we can't back test what 10 different people might do or what 100 different people might do. We can only back test up to the first target. So everything in the spreadsheet is up to the first target. Other than that, it's up to the individual personality, what they want to do.
Yeah.
So different, like I take the first target and I always have a trailing stop in a second because the way some of these moves are super big, I want to be ready for any big move that comes afterwards. So I'm always in with a secondary target that's huge. Because sometimes you just catch those moves and it's like, you feel good too. All right, we have gone way long.
Well, thank you.
Always go long.
All right, so if you put on that trailing stop, so you can't categorize it. So the way you do is you put on the trailing stop, set up to capture capture a large gain, but then you have
Yes.
a greater risk to get stopped out and losing
Yep.
your profit. But when the way you trade, so what sort of annual return does that give?
I don't have I don't trade, I don't put stops in a preset way. I put the stops where I feel like putting a stop, depending on what bills I have to pay this month.
Oh,
I do what I call real life trading. If I'm up a mortgage payment, I might have a tighter stop depending on what bills I have to pay. So
yeah,
you
sure,
cannot back
cover the
test.
bills, yeah.
I know that I get a 50+% return on my futures trades each year. That's easy.
Yeah.
That's just easy. And I know I get a 20 to 40% return on my option account.
Yeah. So
But
why do you even bother? But you're trading, so why do you even bother with the options? It seems you'd be better off.
because I still use the options for gold, silver, oil, and energy.
Because you're tying up separate pools of capital for the
That's correct.
options and the futures,
Yeah,
right?
so with the index futures, I focus on the indices, the Dow, S&P, NASDAQ, and the currencies. And with the options, I focus on like GDX, GLD, USO, UNG, natural gas. So that's how I can trade different markets. Something's always moving. So I can trade different markets with options and trade certain markets with the futures. So that's why I still do both. If I had to pick one, I'd just be trading futures, but I want to trade both. I want to trade options and futures and put my money where it's most efficient.
I mean, you're not, are you, I assume you're keeping these two pools of capital separate. You're not like using
No,
the
it's one,
same capital and switching between the two, right?
Yes, it's one pool of money. My
Yeah,
trader Schwab is one pool of money for options and futures, basically. Yeah, it's the same pool of money at Schwab.
oh, it is. Oh, I see. So if you trade both, you can, when the future opportunities aren't in there, then you can pick up some opportunities in the option.
Yeah, the same pool of money. It just goes,
Yeah.
it just goes in the same pool of money. It doesn't matter. It depends on your broker, how that's set up. But I trade a Schwab and it's just one pool of capital that both accounts pull from the futures or options. Sometimes you might be a futures broker only, then that's different. So I'm going to end this now. Robert, if you want to keep chatting, give me a call later and we can talk some more, or email me and we set up a time to talk.
Okay, well, thank you so much. Yeah.
But yeah, it's this is a good time to get going on options if you want to do it. I said between October and April, capitalize on those trends. It gets a little bit more choppy during the summertime, but now is the time to make money. And this coming week, look for massive volatility this week. This is going to be the first FOMC, the first Fed announcement of 2022. Is it this coming week? Let's see, it's the 20, yes, this coming week. On Wednesday, midday Wednesday, 11 a.m. Wednesday. First FOMC. It's going to be massive. Plus, we have some other currency announcements coming up this week also. So look for major market movement this week. That will happen between Wednesday, Thursday, and Friday. That's why we position all of our trades. We get into them, make sure your targets are in, your stops are in. Futures. This is when we make our money. The market's going to be moving, and we want to be ready for it.
So this is really, most of your gains are going to be this.
The gains happen when you get, if you get a technical buy or sell signal backed up by a major fundamental event driving it. Those are the best ones. Technical is great. We trade technical, but when you get technical backed up by fundamental, even better.
Yeah.
Yeah. And
here's the thing. Right now, I can the only money I'd only be able to put in. Only have about 10 grand available for my account.
Call me and we can talk a little bit more in detail about your specific situation, or email me and I'm set up a time to chat later on.
I do much better if I can call you or
yeah.
I've got your number anyway.
I want to make sure you have a realistic expectation,
Yeah, right. Yeah. Well, thank you so much.
All right, I'm going to head out and we'll probably set up something for probably the middle of February. It'll probably be one of the Ichimoku strategies we haven't done for a while, probably the Senku or the maybe even market internal. So stay tuned.
Do what in February?
Go over, just let me know for the next meetup.
Okay. Well, okay.
All right.
Thanks again. Well,
catch you guys next month. If you want to talk to me about any of the coaching, because there's 3 different programs and the discounts, just let me know. And we can start as early as this week. And it's all one-on-one. All right,
Great.
talk to you guys soon.
Yeah.
Thank you.